For most of my life, people assumed the dollar was just money. That was the mistake. The dollar was never just money. It was a delivery system for power. It was an agreement about who got paid first, who borrowed cheapest, who set the terms of trade, and who could live beyond his means without looking irresponsible. If you misunderstand that, you misunderstand the entire game. When I was younger, I learned to look for simple incentives instead of grand slogans. Nations talk about peace, freedom, rules, stability, partnership, and cooperation. Fine, I do not invest in speeches. I invest in flows. I look at who must buy what in what currency, through which route, from which region, under whose protection, and with what collateral behind it. That is why I want to talk plainly about what people are calling the end of the petrodollar. Most people hear that phrase and they either shrug or panic. They shrug because it sounds academic. They panic because it sounds apocalyptic. Both reactions miss the real point. The real point is not that the dollar vanishes tomorrow morning. The real point is that a 50-year arrangement that quietly forced the world to own dollar assets is losing some of its automatic power. And when that happens, capital does not sit still. It looks for the next structure, it looks for the next protected route, it looks for the next essential resource, it looks for the next political shelter. And when it finds them, wealth is repriced very quickly. That is where ordinary investors get hurt. They keep staring at the old center of gravity while the weight is already shifting somewhere else. I have watched this kind of mistake all my life. A man thinks he owns a sound portfolio because the labels on it are respectable. Blue chip, safe income, pension, treasury exposure, stable cash reserves, broad market diversification. Then the operating system underneath those labels changes. The cash is still cash, but it buys less. The bonds are still bonds, but their real value erodes. The pension still arrives, but the lifestyle it was supposed to secure quietly shrinks. The broad market still rises on paper, but the parts of the world collecting the real strategic upside have changed. The investor thinks he is standing still. In reality, he is moving backward. That is the first rule. When the monetary plumbing changes, the losers are usually not the people who made one dramatic error. The losers are the people who kept obeying an old map after the roads had already been rerouted. For decades, the petrodollar arrangement gave the United States a remarkable advantage. Oil was priced through a dollar-centered system. Countries that needed energy needed dollar liquidity. If they needed dollars, they needed a place to park dollars. If they needed a place to park dollars, U.S. debt and U.S. financial markets sat at the center of the table. That arrangement did not just support the dollar. It supported a hierarchy. It made it easier for the United States to run deficits, easier for American assets to attract foreign demand, easier for Wall Street to intermediate global savings, and easier for Americans to confuse currency privilege with economic virtue. That last part matters. When a country can borrow more easily than its discipline deserves, citizens begin to mistake borrowed comfort for permanent strength. They think the machine is natural. It is not natural. It is engineered. And what is engineered can be altered. Now, when people say the petrodollar is ending, they often jump too quickly to a cartoon ending. They imagine the dollar falling off a cliff in one theatrical week. That is not how big systems usually fail. Big systems decay by losing exclusivity first, then leverage, then prestige, then obedience. The most dangerous phase is not the final break. The most dangerous phase is the middle phase, where the system still looks dominant enough to reassure lazy people, but no longer dominant enough to force everyone else to play by the old rules. That is where wealth transfer begins. I want you to picture this properly. A system like this does not collapse in one line. It fragments in layers. First, trade routes get rearranged. Second, commodity flows start looking for regional security instead of old ideological alliances. Third, countries become more willing to settle trade outside the old default system when it suits them. Fourth, strategic industries stop caring only about labor cost and start caring about resilience, control, and proximity. Fifth, capital starts to pay more for real access than for elegant theory. That is, when investors who are still waiting for a television anchor to declare the new era officially open discover that the good prices are gone. The money was never waiting for permission. It was already moving. That is why I think the bigger story here is not oil by itself. Oil is the headline. The structure underneath it is the story. The structure underneath it is regionalization. For years, the world optimized for the cheapest possible global supply chain. It was a beautiful spreadsheet and a fragile civilization. The whole thing worked as long as shipping lanes were safe, energy routes were unquestioned, Great powers behaved like reliable traffic police, and politics remained subordinate to logistics. That world is gone. Now the premium is shifting from cheapest production to secure production, from global reach to controllable reach, from abstract efficiency to protected throughput, from importing vulnerability to owning the critical chain. That is why I do not look at the Middle East and see only oil. I look at it and I ask a more important question. If the old energy security bargain weakens, where does capital go to rebuild control? And once you ask that question, you stop seeing the Western Hemisphere the old way. You stop seeing it as background scenery. You start seeing it as inventory, energy corridors, port systems, mineral belts, refining capacity, logistics, links, security radius, political influence, nearshore labor, industrial retooling, strategic redundancy. That is not ideology. That is geometry. Empires age. Geography does not. If I were trying to prepare for a world where dollar privilege erodes slowly rather than explosively, and where reshoring and friendshoring become less of a slogan and more of a survival mechanism, I would not spend my time fantasizing about the perfect macro forecast. I would spend my time studying where supply chains become shorter, where processing capacity becomes more valuable, where resources stop being distant commodities and start becoming local leverage. That is why Cuba belongs in this conversation, even if many people still laugh when they hear it. Cuba is not important because it is fashionable. Cuba is important because neglected places with strategic deposits become very important when a system can no longer afford long, fragile, ideology-heavy supply chains. The average investor still imagines wealth transfer as a software chart or a central bank statement. Real wealth transfer is usually much more physical than that. It is ports, it is pipelines, it is rails, it is grids, it is storage, it is processing, it is energy, it is copper, nickel, cobalt, rare earths, fertilizer, shipping, and steel. It is the boring body that the glamorous digital brain depends on. When the world races toward batteries, defense electronics, drones, data centers, and electrified transport, the conversation sounds futuristic. The money, however, keeps crawling back to the dirt, back to ore bodies, back to power, back to the people who can move molecules and metals at scale. This is where many clever people lose themselves. They hear a phrase like artificial intelligence and they buy stories. I hear a phrase like artificial intelligence and I ask who must own the picks, the wires, the cooling, the fuel, the substations, the transformer chain, the metal feedstock, the shipping, the permits, the insurance, the throughput. Dreams sell at the top. Bottlenecks make money for a long time. That is the second rule. When a civilization claims to be entering a new era, do not begin with the story it tells about itself. Begin with the raw materials and constrained routes without which the story cannot happen. The petrodollar debate matters because it changes what people are willing to pay for security. If the world requires fewer dollars at the margin to conduct trade, that does not produce instant annihilation. It produces a subtler and more durable consequence. It weakens the old assumption that dollar assets deserve automatic demand. When automatic demand weakens, financing costs matter more. When financing costs matter more, weak balance sheets get punished harder. When weak balance sheets get punished harder, countries and companies start redesigning themselves around control instead of hope. That is the great reshoring story in one sentence. It is not patriotic marketing. It is a cost of insecurity being repriced into every major industrial decision. And once that happens, the winners are not always the companies with the prettiest branding. The winners are often the companies sitting at the unglamorous choke points of the redesign. I want to be very blunt about what most people get wrong here. They believe owning assets is enough. It is not enough. Owning the wrong assets in a regime shift is how people stay nominally rich and functionally poorer. If your wealth is heavily tied to long-duration promises denominated in a weakening unit of account, you may look prudent while slowly being diluted. If your wealth is heavily tied to passive structures that benefited from a 40-year tailwind of globalization, disinflation, and unquestioned reserve status, you may call yourself diversified while actually sitting on one giant old-world bet. If your wealth is heavily tied to salary, pension, and cash savings, you are not safe. You are exposed to the most silent confiscation mechanism ever invented, a system that lowers your purchasing power while letting you believe you are still being paid in full. That is what enrages people later. Nobody stole the statement. They stole the meaning of the statement. A man sees the same number of dollars arriving and assumes his position is intact. Meanwhile, shelter, food, insurance, fuel, travel, education, and maintenance move to a different altitude. He thinks the betrayal is sudden because he notices it late. In truth, it was happening continuously. The people who survive that environment best are not always the most intelligent. They are the people who stop worshiping labels and start understanding economic function. Cash is not safety if the unit is weakening faster than your yield can defend it. Long bonds are not safety if policy and fiscal arithmetic are moving against duration. A fixed pension is not safety if the basket of goods you must buy outruns the payment stream. Even broad equity exposure is not true safety if it is concentrated in a version of prosperity that depended on yesterday's global plumbing. True safety in a transition period is not found in comfort. It is found in relevance. Ask one question about every asset you own. If the world moves toward regional supply control, strategic resource scarcity, and weaker currency purchasing power, does this asset become more necessary, less necessary, or merely more discussed? More discussed is not enough. More necessary is what matters. That is why I become suspicious when people say, just buy what everyone already owns and wait. I have spent most of my career praising patience. But patience only works if the thing you own remains economically central. Patience is not magic. It does not rescue a bad premise. If the next decade belongs more to regional hard asset control than to the smooth abstractions of the last cycle, then your portfolio must admit that honestly, not hysterically honestly. That does not mean you dump every conventional asset and hide under the table with canned food and bullion. It means you stop pretending there is no difference between paper claims and strategic control. It means you understand why mineral access matters more when resource nationalism rises. It means you understand why infrastructure matters more when root security matters more. It means you understand why commodity, adjacent businesses can become more valuable. Even if their investor relations presentations remain ugly and unfashionable. It means you understand why the winners of a new order often look cheap, cyclical, politically messy, and operationally boring right before they become obvious. This is also where discipline matters. A lot of investors hear a thesis like this and immediately do something foolish. They buy the most dramatic ticker they can find, the smallest company with the loudest promise, the most speculative corner of a good theme. They confuse being early with being reckless. That is not how I have ever liked to operate. When a macro tide shifts, I do not begin with the most fragile boat. I begin with the bridges, the toll roads, the refineries, the processors, the balance sheets, the businesses with actual leverage to the shift and enough durability to survive the delays, politics, false starts, and temporary reversals that always come with real-world change. The reason ordinary investors lose in great transitions is not simply that they miss the theme. They lose because they either arrive too late or they arrive stupid. Too late means they buy after the story is socially comfortable. Stupid means they buy what sounds most explosive instead of what is most economically indispensable. I prefer indispensable. If the Caribbean and broader Western Hemisphere become more important as supply, processing, and security zones, that is not a one-week trade. That is a multi-year repricing of relevance. The market will not move in a straight line. It will lurch, overreact, ridicule, forget, rediscover, and then finally institutionalize the thesis. That is the normal pattern. First, almost nobody cares. Then, a few specialists care. Then prices move before the story is socially accepted. Then commentators call it a fluke. Then the move broadens. Then everyone pretends it was obvious. Then the easy money is gone. I have watched that movie more times than I can count. So if you ask me what to do with a world where the petrodollar's grip loosens, where reshoring matters more, where strategic materials matter more, and where capital needs a new map, I would answer this way. First, stop measuring safety by familiarity. Second, stop confusing cash with optionality if the currency itself is under long pressure. Third, examine whether the assets you own benefit from the emerging structure or merely from the old one. Fourth, favor assets and businesses tied to necessity, scarcity, throughput, and control. Fifth, stop waiting for consensus. Consensus is where returns go to die. And sixth, never buy something you cannot explain in one clean paragraph without using performance charts as a crutch. If you cannot explain why an asset matters in the new operating system, You do not own an investment. You own a mood. I do not want moods. I want assets that become more valuable because the world has fewer choices without them. That is the kind of wealth that survives transitions. The older I get, the less impressed I am by financial elegance, and the more impressed I am by economic necessity. A pretty theory about stability is no match for a dirty mine that produces what the next regime must have. A polished promise of protection is no match for a real asset with pricing power when the unit of account weakens. A pension brochure is no match for productive ownership when the purchasing power of wages and fixed checks keeps eroding, and a portfolio built for yesterday's privilege is no match for one built around tomorrow's bottlenecks. I would not tell you the sky is falling. I would tell you the floor plan is changing. That sounds less exciting, but it is more dangerous, because most people do not notice a new floor plan until they have already walked into the wrong room. The end of the petrodollar, if that phrase must be used, is not a bell ringing at noon. It is a migration of settlements, incentives, routes, dependencies, and power. It is a migration of capital away from automatic assumptions and toward strategic necessity. It is a migration from one monetary operating system to another, not all at once, but enough at the margin to make old laziness very expensive. You do not need to predict the exact day. You do need to decide which side of the migration you want to stand on. On one side are the people still begging yesterday's system to resume behaving like a permanent entitlement. On the other side are the people quietly buying relevance before the brochures are printed. I know which side I prefer. I would rather own the things the next system must pay up for than cling to the things the old system once made easy. That is not fear. That is not speculation. That is just reading incentives the way they are, not the way they were. And if you remember nothing else from me, remember this. Currencies do not lose their throne in a speech. They lose it one practical workaround at a time. And fortunes are not built by noticing the obituary. They are built by noticing the workaround early. Let me make this even more practical. Imagine two households with identical income, identical intelligence, and identical work ethic. The first household keeps doing what the last era rewarded. Big retirement contributions into generic paper exposure, plenty of cash for safety, long bonds for stability, a respectable house in a respectable suburb, good salaries, good intentions. They do not feel reckless. They feel mature. And for a long time, they may even look correct. But if the underlying currency regime weakens and the world begins paying more for strategic control than for passive claims, this household will discover that respectable is not the same thing as protected. Their statement will still arrive. Their dignity will still be intact. Their real advantage, however, will be leaking away. The second household studies the same world and asks a harsher question. What if the next decade rewards ownership of things that cannot be willed into existence by policy press conferences? What if value accrues not to the most elegant narrative, but to the ugliest essential input? What if the safest place is not where everyone feels calm, but where the next industrial order will be forced to spend? That household does not need to become reckless to benefit. It simply needs to stop treating all assets as morally equivalent. $1 in a deposit account is not the same as a claim on productive scarcity. A bond yielding a polite number is not the same as a business with hard asset leverage and pricing power. A passive allocation built for a low-friction global system is not the same as a portfolio that can absorb regionalization, supply conflict, and real resource repricing. This is what I mean by an operating system. Most investors still think they are choosing products. In reality, they are choosing the hidden rules that will govern how those products behave. Under the old operating system, convenience won. Under the new one, resilience commands a premium. Under the old operating system, distance barely mattered. Under the new one, distance can become a tax under the old operating system. Cheap money and unquestioned reserve status did most of the heavy lifting. Under the new one, ownership of strategic necessity starts doing more of it. That is why I become suspicious when I hear people say the answer is simply to stay diversified. Diversified across what? Across 10 versions of the same old assumption, across multiple wrappers around the same sensitivity to the same weakening unit, across a collection of assets that all did well because the same global arrangement suppressed cost volatility and geopolitical friction. That is not diversification. That is repetition with better branding. Real diversification in a transition is exposure to different drivers of value, exposure to monetary erosion, exposure to resource scarcity, exposure to regional industrial rebuilding, exposure to businesses that can pass through inflation because they sit near a necessity instead of a luxury, exposure to assets whose usefulness rises when governments lose some of their financial grace and must lean harder on real production. Now, I do not say this to flatter hard. Asset romanticism. I am interested in cash flows, replacement value, and strategic relevance. If a mine never produces, it is a fantasy. If an infrastructure dream never gets financed, it is a brochure. If a critical mineral story has no path to processing, transport, or political permission, it is a hobby masquerading as analysis. I want the things that connect. I want the businesses and assets that convert a regime shift into repeatable economic advantage. A lot of people hearing this will still do nothing because they prefer the comfort of familiar underperformance to the discomfort of intelligent repositioning. That is one of the oldest habits in finance. People say they fear risk, but often what they really fear is embarrassment. They would rather lose conventionally than think independently and be forced to defend it. That is a very expensive personality trait in a structural transition. I have no interest in being unconventional for its own sake. I care only whether the math has changed, and I believe the math has changed. The old bargain of endless dollar convenience, ever cheap global labor, unquestioned route security, and easy financial gravity toward the United States is no longer as frictionless as investors still assume. It still exists. It still matters. But it no longer deserves lazy faith. That means your job is not to predict a dramatic ending. Your job is to build a contract with the future version of yourself. A contract that says this: I will not sit entirely in melting claims and call it prudence. I will not outsource every important judgment to yesterday's consensus. I will not confuse televised certainty with real safety. I will not wait for strategic assets to become socially comfortable before I admit they matter. I will not keep every dollar in forms that depend on old monetary privileges staying cleaner and longer than history suggests. I will own some reality. That final phrase matters more than most people think. Own some reality, own something tied to production, own something tied to throughput, own something tied to scarcity, own something tied to necessity, own something that benefits if the world pays more for security than for convenience. Own something that still matters when confidence in paper claims becomes less automatic. If you do that, you do not need to become a prophet. You only need to stop being asleep. And in my experience, that is how most large fortunes are protected. Not by brilliance at the exact moment of crisis. By being positioned one layer closer to reality before everybody else notices. That reality is what the market is about to reprice.